It's certainly very topical to think about what the future of super fund investing is, not just based on what we've seen in the last 12 months, but over the last several years. The role of super funds in not just the financial sector, but the economy more broadly, has perhaps never been more prominent. Some of the issues that I think are particularly relevant and that I expect may be canvassed today is around the role of super funds in terms of their investment strategy, particularly things like funding infrastructure, funding the transition away from fossil fuels, some of the implications coming out of COVID, what we can expect to see in the sort of environment going forward, given the responses that we've seen to COVID from business, from government, and from business and from other organisations. High and growing government debt, on the other hand, record low interest rates, a lot of discussion about what the future will be with regard to things like inflation, and also some discussion around things like the level of the compulsory contribution to super. One thing that struck me, I certainly hadn't expected, was that last year when the government allowed people to make withdrawals from their super funds for various purposes, quite a lot of people took that option up. And that might suggest that the industry perhaps needs to do more about getting the message across about the value of retirement income planning as well. So we've got a terrific panel to discuss those things today. And I'd like to hand over to Rob now to introduce them and to start the discussion. Thank you.
Thank you, Professor Nolan. Firstly, for those CFA members who have joined this conference for this session, welcome, and please note that the Zoom Q&A is not going to be functioning. Rather, you will need to download a different app called Slido, and that's one that's going to be used for Q&A. You'll need to register on Slido and then type in the details provided in the Zoom chat function. So if you go to the Zoom chat function, that's where you'll find some instructions as to how to download Slido. But you do have a good half hour or so to do that while you're listening to our speakers. So the topic for this plenary is the future of super fund investing. Our panel is comprised of 3 global leaders in their field. I'm grateful to each of them for making the time to speak today, because they all are very busy people. Each of them has a different topic, although there is an overlap. And these topics are particularly pertinent for the future of Australian super funds investing, and equally so for the investment management industry more broadly. The speaking order is actually going to be reversed from that shown in the conference ebook. This way we'll start broad and then go a bit more narrow with the latter speakers. With that, I'm pleased to introduce our first speaker, Mark Delaney, CFA. Mark is the long-standing CIO and Deputy CEO of Australian Super. Ian might not be all that happy about me promoting you straight away. Mark Delaney was appointed the Chief Investment Officer and Deputy CEO of Australian Super in July 2006 after the mergers of ARF and STA. Mark has the, I'm going to say unenviable, or maybe it is enviable, responsibility of investing currently over $200 billion of members' retirement savings. In his time, he's expanded Australian Super's in-house investment management capabilities significantly and has been one of the leaders in building an internal team within Australia. But he does combine that with external advisors to continue absolutely top quartile investment returns to Australian Super's members. He holds a Bachelor of Economics with honours. He's a chartered financial analyst and a director of IFM Investors Advisory Board. In February 2021, he was appointed as Vice Chair of the Pacific Pension and Investment Institution. Mark is discussing how the pandemic has changed the way super funds think about investing. Over to you, Mark.
Thanks, Rob. Firstly, I'll say thanks to the organisers, Phil and Rob, for the introduction. I'll try and share my screen now. So the topic is a big one. And I sort of struggled as to where to start. And I had some ideas, which I put to Rob, but it's a bit like putting my homework. And he sent the back saying, no, you got half right, but if you try a bit harder, you'll get there. So I had another go at it and then another go at it. So you're getting my best efforts after correction. So let me just go. There's four things I want to talk about. Actually, I'll just come back up again. The disclaimer is important. It's important to know that this is not investment advice and shouldn't be interpreted as such. There's four things I'll talk about: COVID and markets, secular winners and losers, what society looks like post-COVID, and we'll cover that, I suspect, as we work our way through the topic, and super fund investing post-COVID. Now, before we get off that, I shall go back to here. There's been four big changes which has occurred post-COVID. And I'll pick these up as I work my way through the information. The first one is a complete regime change in the way economic policy is conducted. A complete regime change. All the rules which are devised in the early 1980s have been thrown out. Complete regime change. The second one is, in business, digital is the new normal. If you don't have a digital business model, you wonder where your business is heading. The third thing, it might sound controversial, but when you think about it, I think you'll accept it's pretty likely, is that politicians have moved to centre stage. Directions from government, not markets, has become the norm as to how things are done. And that's partly in response to issues which haven't been addressed, but it's been picked up, you see, in carbon, regulation, diversity, and even the international political environment. So governments are much more centre stage than what they've been any period in the last 30 years. The final thing, and you won't be surprised for me saying this, is that investing is more difficult, because it's always more difficult. Valuations, liquidity, and scrutiny make super fund investing more difficult in the next 10 years than what it was in the previous 10 years. So with those sort of four thoughts in the back of your mind, I'll work myself through the content. These are the OECD forecasts for the major economies. So when I think about investing, really the biggest driver is the economic outlook. And you can see here, they're forecasting a booming recovery 21 and in 22 on the back of COVID. The US is likely to grow by 6 to 7% this year and 4% next year. Huge numbers. Most of these economies lost economic output during 2020 and grew by about 5% below potential. Now, why this idea of below potential matters is because if the economy grows below potential, it's not as inclusive as it could be. And that becomes the political narrative as to how policy is set. Let's have a look at the asset markets. On the left is the S&P 500 and on the right is the 10-year Treasury yields. What you see here is the equity market had a spike down for COVID in early 2020. But if you're looking at that graph and going out 20 years, you'll barely see it. It's just another wiggle on the line that goes along. And the thing that strikes you about markets is when you go back and look at the big market downturns you've been through, the upheavals and whatever, on a long-term graph, you can barely see them. You can barely see them because time takes care of a lot of things. The second thing which comes out, which is probably far more telling, is that interest rates are now really low, but on the way back to normalising. And that's a big conversation point for investors. Now, back to this point about policy framework, have a look at the budget deficits. The norm was maybe you run a budget deficit of 3 or 4% in a downturn. In the US, they ran 16% of GDP downturn, a budget deficit in 2020. Australia ran 13 and China ran 12. These numbers are not seen outside of wars. So basically, the policymakers had these economies on a war footing for most of last year. Then the other thing is Fed says, this is Jay Powell here. I lifted this photograph from the Financial Times. No rate rise till 24, despite growth upgrade. Again, a different rule framework to before. So they're prepared to spend a lot more. And they're not prepared to tighten interest rates like they used to be. Very different policy framework. The question really becomes, what does that mean for investment markets? And the final thing is, there's going to be a boom you can see here in the graph, which really replaces and adds to what occurred with the COVID downturn. Next topic, winners and losers. This is my digital point. Any digital business, and you pick online retail, for example, and you can pick bricks and mortar retail on the other side, winners, losers. Working from home strategies. How about anything to do with travel, business travel, airports, hotels, tourism, anything. Online entertainment, huge. You wouldn't want to be an artist in the current regime. No work, no theatres, no nothing. And the collapse in interest rates has really pushed up the value of interest rate sensitive assets. Now, the loser really is the government balance sheet, because they've taken on a massive amount of debt. Now, there was someone who wrote that when the governments run these enormous deficits, what they do is bribe the public with their own money. And I think there's a bit of that which has occurred in recent periods. Okay. Now, when I think about investing post-COVID, like most of us, we start with what are valuations like. And the S&P 500 graph we talked about earlier said the S&P's kept on going up and is now expensive. To give you an idea of how big the recovery has been, the S&P got down to low 2000s about February last year and is now almost 4,000, around 4,000. So it's practically doubled. The value of the S&P prior to COVID occurring was about 3,100, 200, and is now 4,000. So that's up 25%. Oh. How could you believe that? Number one lesson. So the S&P is up 25%. So this big boom we're talking about is in the market pricing. It's all there. The markets, as always, look ahead. And so the big recovery we're talking about is in the pricing. Now people are saying, what's going to happen next? Will inflation come back? Well, we don't really know. Inflation is one of the hardest things to forecast. It's been very hard to get right. And central banks, by and large, in their changing their policy regime, have said, we've given up forecasting inflation. We'll believe it when we see it. So will inflation come back? We'll know when we see it, is the answer. Then, beneath the overall valuation picture really is one about what stocks do you buy in the equity market? Because you've had this spectacular run of growth stocks and technology stocks for the last 8 or 9 years. Spectacular. And all the rise in the market is concentrated in a very narrow range of stocks. What do you do about them? Has that secular growth story peaked? So how you build your stock portfolio is probably the biggest investment question going forward. Even probably more important than what stocks, than how many stocks you own, how you build it up. And then value stocks. They were so out of favour, you know, they were hammered by low interest rates, hammered by energy and all those sort of things. Well, now they've got trouble because they're starting to perform better, but will they keep going? Do those industries, which some of them are structurally affected by technology changes and policy frameworks, can they keep on performing? In other words, have they been over discounted? Now, when I narrow back the lens back onto super investing in a post-COVID world, there's a few points I've made here. Some of them could be a little bit controversial, and I've left them all as questions quite deliberately. But have a look at them. Early release. Prior to early release, the superannuation was essentially a closed system. You couldn't have a liquidity event for the system as a whole because the money couldn't leave the system. It's not like banking where people can pull their money out of banking. Here in super, it was a closed system. So what the government did was put a prick into the closed system and allow air out, allow some things out of the system. Well, if that happens again, when you think about liquidity management, you'll have to think about it differently, because if people can take money out of the system, you'll need to actually manage for liquidity withdrawals within the system. So that's clearly something which is on the horizon. But what it did expose, I think, is that the funds and the way the funds go about liquidity management hasn't really evolved that dramatically for a long time. How they treat FX, how they treat commitments, how they treat member switching, all these technicalities around liquidity management, I think could be much better done. And so there's scope for a better outcome there than how we do things. And I think the pressure of potential liquidity issues will force that to be done. The next topic is low interest rates. People have bonds in the portfolio to give diversification, generally for bonds to go up in value when shares go down. But with bond rates being very low, and you saw it with the COVID sell-off, they didn't offer much diversification because interest rates are trapped by this zero floor. So if interest rates can't offer you diversification, where are you going to find it in the portfolio? Can you do it through derivatives? Will you have more currency? How do you go about it? Or do you live with less diversification and accept that's just the world we're in? Regulatory scrutiny, but it's more than regulatory scrutiny, it's other scrutiny as well, is becoming a much bigger deal. And I think the outcome of greater scrutiny will be better practice, as always. And so practice will need to improve to reflect the reality of greater scrutiny. Next one, fund mergers. You've seen this stampede of fund mergers around the place. What that will mean is funds will have to go from investing probably at subscale to investing at scale or at full scale. And that's going to cause a pivot in how they go about investment management. They can't run the old approaches when they're investing at scale. No one in the world can do it. Owning assets. Funds own a lot of assets. What's going to happen with them? What's their responsibility in asset management? Where does it end, and where do the members take on that responsibility? It becomes an important question, particularly around direct investments rather than portfolio investments. Regulation risk in monopoly assets could happen. You've seen that some pressure in the electricity industry, and it's affecting other industries. And then country risk. What do we do about investing in countries where Australia is not as popular as we used to be? How safe is that? Do you use country risk insurance? How do you price country risk? And where does it head? So there's lots of topics in the minutiae of how we run our portfolios, which really feed back up to those four globals I talked about. Now, the final thing I want to talk about really is COVID itself. It really was a health crisis. The job of superfund investing really is to navigate the economic effects, the effects on markets and the regulatory and political environment. But what it has done is trigger these four systemic changes. I'll go back to where I started. A regime change in policy frameworks. Digital has become the new normal. The third one is politicians have moved to centre stage. Carbon, regulations, diversity, global politics. And investing, as always, has become more difficult around valuations, liquidity and scrutiny. So thanks for listening.
Thank you, Mark. There was some truth in his comments in respect to homework. But I think the thing is he did listen to me a bit too sharply when I said you've got 15 to 20 minutes, and he's gone for the 15-minute option, but that's great. That will leave time for further questions from our participants out there. If you could please switch Zoom back over to being able to see all participants. Maybe you need to unshare, Mark, I think.
That might be beyond my skill set.
Excellent.
Yep.
Well done. Well done. You had me worried there for a moment, although I did believe your comment about your skill set. Okay, so to our next speaker. Our second speaker today is Dr. Michael Collo. Michael is the Chief Economist at Fathom AI. Dr. Collo gained his PhD in finance from the London School of Economics before embarking on a career in quantitative asset management, working at a suite of sophisticated institutional asset managers, including BlackRock, Fidelity, and AXA, where he led research teams and also spoke globally on applying quantitative, as in data science, techniques in asset management, the limits and applications of machine learning, and the applications of alternative data for different investment problems. Michael moved back to Australia in 2017, joining Hester to set up the quantitative finance function. I have to admit, that is where I met Michael. Amongst other activities, Michael is a podcaster on the topic of the application of alternative data and artificial intelligence and machine learning in financial services. The podcast is called The Curious Quant, and you can now understand why Michael's a fantastic speaker on this particular topic. Michael joined Fathom in 2020. Fathom is a unique software as a solution analytics platform that uses AI to model the impact of emerging technologies on any economy, industry, organisation, workforce, or job and societies. Again, this is not an ad for Fathom. This is actually giving you the understanding as to why Michael's a great speaker on this topic. Michael recently published an article on LinkedIn regarding how the government could retrain coal industry employees into many new roles as part of the transition to a clean energy economy. If you'd like to see a snapshot of Fathom's work, this is a great article for you to search on LinkedIn. Michael's discussion is artificial intelligence, and I'm going to actually add to it, actual and potential impacts on investing. Over to you, Michael.
Thanks very much, Rob. That's a phenomenal introduction. And yes, indeed, we did meet about what is a little while ago, same with Mary as well. So there you go. We all once shared a boardroom together, I'm sure. So today we will be talking a little bit about the application of AI in superannuation. And really, before we even begin, I think it's worthwhile to talk about that. The term AI here refers to a holding term for lots of different types of data science or quantitative models that help us make better decisions in different areas of a business. It's worthwhile to note that AI has become a bit of a marketing term. So for many people on the call, if you've kind of understood the differences between different kinds of models, you will probably know that true AI in a conceptual sense is not what we are talking about. What we are talking about is how to use these type of data-led models for different areas of an industry, in this case, that being the superannuation industry. And I think I just want to pick up a little bit of the comments we just had a moment ago, which was around the idea of COVID and the digital is the new norm. And I think that certainly has done something to accelerate a short-term trend that we have seen in the importance of technology. But I think I also want to sort of pause a little bit to talk about the industry as a whole. Superannuation in Australia has grown enormously over the last 10, 20, 30 years. And I think for those people that have had careers during this period of time, they've seen small businesses, small funds grow into increasingly large and sophisticated funds that they are today. Like as in with any industry, superannuation it has embraced scale and will kind of continue to embrace scale as it grows up. And that means that, as an example case, Australian Super, I think, sits at somewhere around $190 billion today, and it may well sit at around the 200, if not 250, 300 billion mark in the coming decade. What's interesting about this is that, again, as in with any other industry, this results in the industry's push to embrace things like data, embrace things like scalable solutions. So a solution can't be manual anymore. It has to be scalable, it has to be complete, has to be communicable across a wide variety of stakeholders. Usually this means that industries embrace economies of scale and any technologies that help create more for less. So anything that's efficiency improving and so on. What this means, what this takes us down is down on the road of commoditization, down into a road of lower fees, efficiencies that arise from this, and obviously more expertise in this area. Why this is important is because just from a kind of a 10,000 foot view, this means that this industry, because of its growth trajectory, will likely continue to embrace technology and data-led solutions. So what we're going to talk about is potential applications of AI or quantitative models because they might do a better job than people. But we're also going to note that in this particular case, the industry is growing at such a rate that it should be embracing these types of technologies, again, moving forward. And it's hard, in fact, to imagine a future version of the Australian super industry where we are not making more use of data sets, of modeling techniques, of all these different technologies, given the size and the sophistication of our super funds. So we've got AI everywhere. And that's on the other side. So on the one hand, you've got this super industry that is growing and embracing scale and commoditization and so on. On the other hand, you've got AI, which has its own growth trajectory. And really what we're talking about here is an acknowledgement by some amazing thought leaders around the world that this is going to be big, that within our lifetime, application of AI is going to disrupt almost every industry in every country in some way. That can be very massive disruption, so kind of think of a Netflix moment, but it could be somewhat of a boring disruption where you just see it inching away of jobs and inching away of certain kinds of things that people do. And through that process of automation, essentially decreasing the requirement for human labor within certain jobs that get automated and moved away. So these type of, the aggregate is that with some certainty, we know that the capability of these technology is like electricity, as it was quoted. It will become part of so many different industries. And I think the super industry is no different to that. This is a very busy slide, but I promise I won't linger on it too much. I'm going to talk you through most of this, so you don't need to necessarily read everything here. Generally speaking, a super will have two major uses of data and potentially modeling going forward. One of them, it relates clearly to the investment process. It's very difficult to forecast markets. It's very difficult to tell what is going to happen. And I think we need all the edge and all the information we can possibly get. And the other area of a super company or kind of organization is really about member services. It's about how to service the millions and millions of potential and existing members that are on the platform, how to give them more intelligent services, how to service them more completely. I think I did a quick back of the envelope. You'll forgive me if I get this wrong, Mark, I hope. This is, it's about 2,500 members per employee that Australian Super would have as an example case, right? So that's a kind of a ballpark kind of idea of what scale looks like, and clearly that's going to increase in the future. So what that means is that these kinds of technologies and data systems called AI will increasingly address these two areas of the super world. And I wanted to kind of do a little bit of a laddering exercise very, very quickly here. There's a lot of depth here, so we don't have time, and neither do we have need to cover this. But as you go through one area of this, you talk about all those different elements that a super can do. So it can set up its financial data infrastructure. So that means downloading a tremendous amount of data on all of the assets that it's invested in, that it could be invested in, as well as all the funds it could be allocating money to, the infrastructure projects and so on. It then has to organize those in a centrally place. It has to clean the data. It has to create those types of dashboards and monitoring and the systems that help it do that. So there's a fair amount of complexity here. We're not really talking about AI, but we're talking about the enablement stages that form before something can be done with that data. The next level is really something that is more about identification models. So this is about not yet forecasting the future, but talking about where can I find certain types of managers? Where can I find certain kinds of ESG investments? Where can I find certain kinds of information about the world? And it's really about the recognition of the fact that as super industry gets bigger, its reach will get bigger and bigger globally, because it cannot continue to overexpose itself to a relatively small economy by that point from its standpoint, which is Australia. And as it does that, it needs to be able to access information from many different sources and interpret, evaluate, and identify. This is where some of the machine learning algorithms start to really come into their own. These are typically the things that we see for facial recognition, similar types of algorithms, but really pointed at the direction of news, of information, of stories, of documents, of written things that need to get consolidated down. At this point, we're still not talking about anything amazingly sophisticated, but we are talking about tools that we are using to condense information, to give us more reach, more visibility, more understanding. And really, when we start to move to the right of this is really where we start to get into the interesting parts, which is about how do we better use data to forecast the world. And here we are talking about either basic or more sophisticated forecasting models. We're talking about problems such as asset allocation. We're talking about such as, for example, manager selection. So typically two large levers that the super funds use in order to generate alpha. But we're also talking about risk. We're talking about forecasting risk at different horizons or different kinds of definitions. And we're talking about potentially trading and trade selection kinds of decisions, which again, as it was already pointed to, liquidity being an increasingly important topic will continue to be increasingly important, but also because the size of these trades becomes increasingly big. So when your biggest minority shareholder in top 50 companies in Australia are all super funds, and they want to liquidate any of those positions, they have to be very careful with how they do that, and the trade balancing that they get help from outside service vendors may eventually go inside. So these are all realms that are rich for data analysis, for data forecasting, and I think many of these funds already deploy some amount of quantitative tools and people to do this. But I think certainly going forward, you can see this is an area where they will start to enrich their understanding and their use of these kinds of tools. I think for the data, for the member data set, there's an interesting point here, which is we're talking about profiling people. And we're really talking about that in a marketing sense. So they are customers of Super in order to give them best advice, to give them best information, to understand what their needs are, their retirement plans are, and so on. There's a natural amount of profiling that takes place just based upon the information that these supers will have. This then could flow into areas where you have enrichment of data, which basically means that we start to learn more and more about an individual and their requirements, their needs, information that they may volunteer regarding, for example, their retirement plans, their health, any other information that could basically help with better financial planning decisions or better financial advice, or indeed just a better choice of fund or member option. I think as you move further to the right, you start to get into slightly more nefarious places. And this is an area where I think all companies, including super industries, have to tread quite lightly. And this is really around how do you forecast the actions of people? How do you understand if they're going to be withdrawing their super, if they're going to be moving to another fund, if they are going to be requiring something else from you? And the reason that this becomes quite interesting is as you start to forecast people and people's actions, you start to walk into realms of AI ethics and AI governance and some of these other interesting areas that talk about how bias creeps into these algorithms just from statistical training, and how this can actually have very large ramifications on a society, especially when agents that hold multiple millions of records of a entire community of people will start to make decisions or suggest decisions from these types of sources. I don't think we are there yet. I think everything on the right-hand side of the dotted line is still early stages because it involves quite a lot of tools, quite a lot of investment, quite a lot of competition to drive those tools being adopted and the kind of things that needs to be done. But I feel like the road to scale and the sophistication and the accessibility of those AI tools will take us further and further to the right there. Maybe just as a final slide, I think one of the areas that I think supers are probably at this stage of their evolution, again, it really varies from, let's say, the smaller, less sophisticated to the larger, more sophisticated supers. Generally, size is a good proxy, but not the only proxy of sophistication. You will have increasing embrace of things like natural language processing. So for those people that are listening to this who have a background or have become interested in this area, this is an area that has changed enormously in the last 5 years. We have truly made a generational shifts in our understanding of language to the point where we can translate language better than people can using algorithms and machines. And that's something that we haven't seen. That's the kind of Tower of Babel type of moment that we have accomplished. And not only that, but these algorithms are readily available to use and to take off the shelf from major technology providers. So the access for super funds and their use of it could very well improve substantially, because they need to process so much more information, so much more written information that is thrown at them from the world. And to understand that written information, these technologies can be quite useful. So that's a form of AI, I suppose, but it's very specific to this idea of language and all the written words. I think the second part is certainly more about intelligent communication. So everything from chatbots being more sophisticated to actually voice over automated voice conversations, member services. It was once noted to me by a very large financial firm from Asia that there is no way they could service their clients if they had to put people on phones. Literally, they could not do it. There's not enough telephones in that part of the world to do that. And so they have no choice but to create these enormous scalable solutions for their clients. So that was an interesting example. I don't think we're there yet with us, but I think we will be if we continue to grow at the rate we are. I think as an example, Hester will have somewhere close to 880, 900,000 members. Around Australia, it's a significant number of people to service or talk to and so on. So this idea of how do you kind of use these technologies to improve that type of communication to provide a better service, I think is certainly an area that's interesting. And then finally, I think the hardest one here is decision augmentation. And this is partly because of actually something that was well demonstrated by Mark just now, which is we tend to talk about markets and we talk about uncertainty in a very narrative kind of way. We're human beings sitting around the table making human decisions to the best of our ability. We bring in data and we explain it based upon our understanding of reasoning and rationale. The challenge of AI is that it has its own system of trying to work out the truth, and it learns by itself from data in the best cases, which does not replicate what we think would be a logical way of coming out with a solution. So we can use these tools as a way of questioning ourselves, I suppose, as a kind of augmenting of our decision, but it requires us to allow, I suppose, a different voice to come into that. A different voice that doesn't really have the same human narratives and the same human intonations, but can still pick up patterns and really interesting forecasting ideas. Again, this is something that the world of investment management is struggling with. It's not a super specific comment. And it's one that I think we should see some interesting improvements going forward. So yeah, thanks very much.
I clearly emphasised the 15 in the 15 to 20 minutes too strongly. So thank you, Michael. Our final speaker is Mary Delahanty. Mary is the Head of Impact for Hester and has been with the fund since early 2013. She's held senior roles in financial service organisations for over 15 years and is passionate about progressing responsible investment practices and gender equality. In fact, I've already seen a question come through in the Q&A, which is exactly on that point, so I'll make sure I ask that question. Mary is a 2015 Churchill Fellow, awarded for the completion of international research on equity for women in pension systems. She's a chair of the Ministerial Advisory Council for Gender Equality in the state of Victoria, sits on the advisory board for the McKell Institute. Mary holds a Master of Finance Corporate Advisory and is a graduate of the Australian Institute of Company Directors. Now, going to LinkedIn, I have a quote for you before I hand over to Mary, but this one's not from Mary, which will be a surprise to Mary, but one that I'm sure she will agree with. And the quote is from an overnight post by Nassar El-Sadi, a UK-based ESG practitioner who is quite prolific on LinkedIn. There was a time when economists believed the purpose of the corporation was the financial enrichment of shareholders at the expense of everyone else. Today, it is increasingly clear that financial wealth creation is only sustainable for those corporations to the extent that it addresses the needs of all shareholders. Mary's discussing responsible investments. Over to you, Mary.
Thank you, Rob. That is a good quote. I wish it was from me. If you hadn't have done that, I could have just copied and pasted and put it in my, and shot it out from Mary. That would have been great. Anyway, it's done now. Thank you to the organisers and to Rob and all participants for coming along and listening to the future of super fund investing. And I think it's an incredibly exciting place to work in. And I'm increasingly aware, because I have honest friends, that people don't always think that super is an exciting place to work in. But when you look at the what we can do in terms of purpose and responsible investing, this is where, for me, it is. It's a genuine sort of social movement and a way that I can live my values and finance skills at the same time. So I think I'm excited to be able to talk to you about a few of those things today. I want to start, though, by acknowledging that I'm coming to you from the lands of the Boonwurrung people of the Kulin Nation, and to pay my respect to elders past, present and emerging. I'll add to Mark's disclaimer and remind you that I won't be providing personal financial advice today, and that this information is general in nature, and that should give you great comfort, because you don't want financial advice from me in a personal nature, let me tell you. And I'll also say that perhaps after years of working with Rob, the way you avoid him correcting your homework is to not submit any. So I don't have any slides, and I'm going to pretend that that is because I like to have a dynamic, discussion. But I think I'm done really with slides after 2020. I think we're all coming to the end of our Zoom fatigue and slide fatigue. But I do think the future of super fund investing, especially in the sector that seeks to return profit to members, is very exciting because it can be really talked about in a way of capital with purpose. So you can call it impact, you can call it responsible investment, lots of different names, but what it means is truly understanding the responsibility of universal owners. So if we come to a discussion of purpose and of impact, I don't usually like to get caught up in definitions, but it is important to have a consistent understanding of concepts, I think. And firstly, let's discuss universal ownership and what it means to us, what it means at HESTA. So we think that universal ownership refers to an investor with a large investment portfolio, diversified across asset classes and sectors and geographies, etc., such that they are effectively invested in a slice of the global economy. And as such, what that means for us is that we can't diversify away all risk. And we are therefore affected by the health of the global economy. Why it's important to have a consistent view of that concept is because it can direct the actions of responsible investors. And it's a contemporary way of thinking about it that has, I think we've been led to this point from years of people in the industry, people like the giant that is Rob Fowler, who started, at the portfolio level, figuring out what it is, what does responsible investment mean to investors? What these people did in that embryonic stage of thinking about what responsible investment is try and take a system view all the way down to the portfolio level. And we've by coining the term of universal ownership and trying to work out what that means in our operations, we're doing that at a level that is growing with funds. So that kind of concept, as you can imagine, if you think about you own a slice of the global economy, if you think about, HESTA at I think around $60 billion at the moment, so not a drop on Australian super, but purple, and so that makes a difference. That we own a slice of the global economy. Australian funds together own an incredible amount of the global economy. And so what is our obligation in that? What is our stewardship? What are we doing about stewardship? What are we doing about the world in which members will retire into? Universal ownership is more than just a concept that exists in the ether. It is something that affects our everyday operational decisions. And the other term I think it's important to have some consistency around, and I would love for Australia to be able to, sort of almost agree to this, is the term of impact. At HESTA, and I think globally really, it's not just about impact investing. It's not about having an investment that also has a social purpose. If you think about that universal ownership concept, every decision that we make can have an impact somewhere. Every decision that we make in the investment portfolio, every decision that we make with our voice, our advocacy, every decision that we make as an employer can have an impact on something somewhere. So as a universal owner, how do we take those two concepts of owning a slice of the global economy and understanding that our decisions can have wide ramifications and wide impact, and put them together to create something that is the ambitions for a better world? It's not easy, but it is actually a day-to-day conversation if responsible investment is being lived in an organisation. And I think you don't have to look much further than the profit to members sector to find organisations that genuinely live the concept of responsible investment. The challenge, I think, becomes, and it certainly was at HESTA, so if we understand these two things, how do you figure out what matters? Because there are so many different things that people can do, that super funds can do to advance this concept of a better world. What do you pick? How do you possibly narrow down where your sphere of influence should be how you pick what matters most. For super funds that have a cohort of members that pretty well look the same, as in at HESTA, we've come from the health and community services sector. So our members largely draw from that sector. They have a similarity to them. That helps. It's very helpful to narrow down then what matters. It's been helpful for us to be able to see the world through our members' eyes, because it's their money that we're using to try and promote a better world. So it's got to be a better world to them. And so that's really helpful to be able to narrow down what matters. But to have a consistent language and an international language, we've also used the Sustainable Development Goals to describe those concepts that matter to our members. The Sustainable Development Goals, the United Nations set of goals and global ambitions, really help to kind of contain and theme these concepts of responsible investment, concepts of a better world, to a level that is consistent across international pension funds and consistent across the finance movement more broadly. And so how do you figure out what matters? For us, it's through the eyes of the members. Our members will live, work and retire largely in Australia. And so what matters to them is the better world, you know, where they will live, work and retire. And so we came up with 6 broad themes about what matters to our members in terms of responsible investment. And then we look at how do you have impact in those areas. I think this is really the exciting place for super funds to be. For it to matter to a super fund, it has to matter in a fiduciary sense. It has to matter to the members' returns. That's not necessarily a constraint. It sounds like it the way I'm describing it. It's not a constraint, it's a lens, I think. And it's a good lens to have. We're the guardians of members' foregone wages, basically, and I hold them for them until they have to retire. As guardians of foregone wages, we promise to do certain things. We promise to make sure that those wages, that we seek a return for them. And that return can be in a number of different ways. Financial, yes, but how do we actually influence a financial return? Can be at a system level as well. But so it's not a constraint to say, look, you have to think like a capitalist, as I say to the team all the time. We have to put our lens on to say, how does it actually matter to members' returns? So how do you get some sort of universal concept of a United Nations Sustainable Development Goal and bring it all the way down to mattering to members' returns, and mattering to that 43-year-old woman who works in an aged care facility, who works part-time, has given up some of her working life to be able to care for others in an unpaid capacity. How does it matter to her that the United Nations says we should pursue gender equality? So how to do that through an investor lens is the exciting spot that super funds need to be able to lean into, because there's always an investor angle to a better world concept. Some of it can be, you know, at the company level, some of it might be more so at a sector level, some of it will be at a system level. The noise you can hear in the background is my dog actually playing with a toy, not barking, as Marx was. I think Marx was actually trying to add into the conversation earlier. So mine has nothing to say, but would like to play with toys, so excuse the noise. So how does it matter? How does it matter? How do we take these universal concepts all the way down to the member level? How do you see them through the investor lens? How do you work it back up through a sector to the system level? And it's not easy, and it looks very messy when you try to do it in the abstract. But if I could talk you through a theme, or a recent example, which might be helpful. So recently, and I'm sure it's not news to any of you, one of Australia's and the world's major companies committed what we would think would be, some gross intergenerational destruction of heritage assets of this country when Rio Tinto blew up the caves at Juukan Gorge. Now, that was a devastation for many of us in the country, none the least for traditional owners and the people of the PKKP groups in the Pilbara. So what is the investor response to something like that, and what is our obligation in that space? And I think to take that concept of universal ownership and apply it to this becomes really, really useful. So yes, we all, most of us own shares in Rio Tinto. So we become, it's actually us then as the owners who have committed this particular destruction, and the board as our representatives have overseen it. So we have an obligation then to understand our role in that. We have an obligation to understand what it does though through the investor lens. What it can do through the investor lens is actually destroy value in a company over time. And it sounds like I'm going really quickly from something that's guttural, devastating that they blew up a heritage site, to what does it mean for money? But remembering that that is the lens through which we must consider it. Not a constraint, just a lens. And it can be weighty and it can be significant, because we can talk to the people who can change those actions very quickly. So because we can see it through the investor lens, we can go straight to the board. We can go straight to the board of Rio Tinto and we can talk to them about their operations. Yeah. But we can also work back up through the sector. What happened at Rio may be a systemic risk, maybe a sector-wide risk. Let's examine that. Let's go up to the sector level and see where else those risks might exist. So what we did in that case was look at 14 other companies that may have exposure to the way in which traditional owners have made agreements with companies. That's where we saw the risk was in that legal agreements, and figure out at the sector level what else is happening to address those risks. What happens next one up at the system level? Next one up at the system level is I think the parliamentary response. How was it legal? How was that action legal? And should that be, and does that reflect community expectations? Because if it doesn't, then that requires a system change. You can still see that the investor has a role to play at the system level because we're exposed to the economy more broadly. Because we are a universal owner, it matters to us whether the system reflects community values, because that can destroy the value of companies. So we're going up from an incident, up through the company to the sector level to the system level. And we're coming back down into the, right, there must be an investment process, an investor response at the member account level. This is very much a what would we change in order to not have that happen again? What risks should we see as investors, and what should we talk to companies about so that that doesn't happen again? You can really work through any theme in that way. That is that's a very recent sort of example of how you think back up and back down, and why I think that is the future of capital with purpose. But you can put a gender lens hat on that. You can pop there's no hats, by the way, we don't do hats yet, we should. You can pop a climate action sort of theme on that, it works the same way. You can really think through any of those sustainable development goals, which is, some global policy initiatives, all the way through the portfolio, all the way through all the actions that you take, down to the member level and all the way back up again. And I think that there is the exciting future, when we are intentional about our capital with purpose, when we are intentional about our impact. That becomes how you apply some, deep technical financial skills to making the world a better place. And that's really what I would love to have everyone walk away thinking, and think about how exciting it is to be a part of that kind of world, because we think it is.
I'm taking silence means you've finished, Mary.
I'm done. Oh yes, thanks, Rob. All done. Yeah.
And just on 15 minutes as well. So we have a reasonable amount of time now for questions. I'd first like to say a couple of things. Firstly, so interesting that Mary was talking about purposeful capital, because for those of you who'd like to go onto the CFA website, they have recently released a number of documents called The Future of Investment Management. I know that Maria spoke to the future of sustainability prior to this plenary, but there's also one there in respect to the future of investment management. And purposeful capital is in fact one of those key drivers that the CFA has identified as a really important future goal for the investment management industry. Otherwise, it will not be a sustainable industry. And I mean that it will not be self-sustained. Now, I was going to next jump to my prerogative as the moderator to ask the first question, but I noticed Mark seemed to be scribbling prolifically when Mary was talking about Rio Tinto. Did you have something you wanted to say there, Mark? And I'll give you the floor now before I ask my question, or were you just doodling?
Actual fact, I was preparing for your question, Rob. But I'm right behind what Mary said about Rio Tinto. I think when I think about purposeful capital or broader stakeholder objectives and whatever, people regard them as being different from financial outcomes. I think that's the mistake. I think that's a mistake. I think managing all your stakeholders and operating as a good community citizen is good business management and good investing. So I don't think they need to be viewed as being distinct, and often they are portrayed as such.
Completely agree. So given you were doing your homework there, Mark, for my first question, I'll now pose it. Even though I was going to ask Mary first, I might now switch that around. So as I mentioned in introducing Michael, the work that Fathom had done on the opportunities to transition coal workers to new jobs as coal-fired power is phased out in this country and hopefully globally. My question is, what is the future role of super funds in the transition of workers from declining industries into new roles? So I will let you answer that first, Mark. Then I'll go to Mary and Michael.
Yeah, thanks, Rob. Look, the first point is this energy transition is inevitable. It's already happening. There was speculation that the new US administration might be aiming for net zero by 2030, not 2050, for example. So it's happening and happening in a hurry. And so it has inevitability about it, which we'll have to come to terms with as a nation. But it's not the first industry Australia has restructured. There's been heaps of examples of restructuring taking place over the last 40 years. Car industry, textile industry, when they protected the Daintree, heaps of these adjustment things which have gone through. In each case, those people who were employed in those industries, and one of the predecessor funds, when I started that, was called Superannuation Trust of Australia, was the manufacturing work, basically the manufacturing workers in Australia, and they were very heavily disrupted by all the changes around public policy. So it's not new. And in each case, workers are displaced, but what we need to do is for the companies themselves and to consider their social responsibilities in terms of how you do this transition. But I suspect the cost of transition won't be just borne by the companies, it'll be borne by the community as a whole, and we'll have to have a very considered response to doing it. There has been some proposals around doing it, and I think there'll be more need to be done, but transitioning workers from industries which are going to be restructured is something we will do for the next 200, 300 years. This is not a unique problem.
So I'm going to hand over to Mary, and at the risk of putting words in her mouth, which is a very dangerous thing to do, I think she's going to say that it's up to the shareholders of those companies to hold them to account to ensure that they do take that social responsibility seriously. Over to you, Mary.
Oh, thank you. I think it's up to the shareholders of the company. No, you make a good point, and there is a role. There's a role for the entire ecosystem here, and I don't think that universal owners, I don't think the big super funds are the be all and end all answer to this, but we are in a vacuum of a lack of government policy. It is actually unfair. Yeah, we've transitioned many workforces before. It is actually unfair that such a disorderly transition be allowed to happen without a government policy about it. It's really unfair to the workers. It's unfair to the communities. We often talk about, for example, let's look at AGL and the Latrobe Valley. And we have shareholdings in HESTA has shareholdings in AGL. Most superannuation funds do. We're often asked, indeed lobbied to walk away from those shareholdings to divest. We have a lot of meaty conversations with AGL at the moment about their plans and how they intend to transition away from coal, which they are in furious agreement is a dying industry and rapidly dying. And so on the divestment point, just to cover off on that, I think it would be a great shame to lose that seat at the table at the moment when shareholders such as HESTA, Australian Super and others can continue to encourage very strongly that these kind of transitions are well managed. But for HESTA in the Latrobe Valley, there's about 1,800 health workers there as well. Just walking away from coal in the Latrobe Valley will kill small towns. And so that is why it is incredibly important that a transition be planned. And it's already, it's so late in the piece, but that one be planned with the government on board as well. The Victorian government has announced funding there. There's small projects kind of thing, but this requires a large federal response. So there's a role for government. There is a role for super funds. The role for super funds, I think, is in catalysing where the investment should go. So if we want to look at transitioning out of coal, we need to have investment in renewables, and we need preconditions for investment in renewables. Obviously, we need certainty of policy, and here we are at the government's feet again. We need certainty of policy, certainty of tenure, but that will help to actually move capital into renewables. And then we need to figure out how we move workforces, and it's at a local level. And I think the Hunter Valley is an incredibly good example of how you can actually pick up a workforce and pop it back down again. Geelong a little bit, not so much on the car and the manufacturing, but these things can be done and should be done, but they require government initiative as well.
Rob, can
Thanks,
I just
Mary.
come back in here for a sec?
As long as Michael allows you to. Yes.
Just to pick up on what Mary said, I think that governments having a plan is changing. Biden's massive infrastructure stimulatory program is really about energy transition and putting the mechanisms in place to do so. I think that'll become more fashionable rather than less over the next 4 or 5 years.
Okay, thanks. Michael, did you have anything you wanted to add? And I note that Mary did talk about the moving of the Hunter Valley. And I think that was actually Hunter Valley Workforce, I think that was actually what your recent posting was about.
Yeah, look, it's I love the way you describe it, Mary. The pick up and drop off, it was beautiful. Our experience in the retraining of the workforce and I suppose the topics and issues around that, it's a deeply complex and difficult problem. Now, we tackle this, or we try and help this with a quantitative lens, but ultimately we understand it's a very small part of it. Why is this the case? So as an example, coal demand globally is pretty strong and may even get stronger if India picks up a lot more of that. Australia may not decide not to export this, but in the meantime, there is a demand for a resource that we have in the ground. The people in these regions and towns get paid, I quote from a local industry leader, like CEOs. So for them to give up these jobs and to move into other areas, even if they have a healthy respect for the planet, takes some persuasion, or at least takes some failure on those businesses and coal mines to do so. Once you've done that, there's a massive retraining program that has to be undertaken. And I agree, this is a government initiative normally. And to some extent, I think some companies around the world have also considered this. So we work with, as example cases, miners with around the world who have footprints in very large stakeholders in workforces, and they will care deeply about what happens. I'm going to refute a little bit of what Mark said in a very positive way, which is I'm going to say absolutely we have successfully, I say, evolved our workforce, but I would say that the problem is often one of timing. In other words, an industry can fail quicker than you're able to redeploy a workforce and retrain a workforce. And that means that if you're talking to people in their 40s and 50s, and you're asking them to pick up a new set of skills to do something different, or a wide variety of different kinds of jobs they might have some partial skills matches with, as in that study showed in the Hunter, that still requires a mindset, as well as the training, as well as the opportunity for companies to hire new employees with very different industry experiences into other roles that are still well paid, that are still well sought after. The failures of these types of actions are all around us. Detroit, the Midwest in the US, the political consequences, Wales, amongst many other European countries. Manufacturing has failed in many of those places. Again, in this case, jobs have moved overseas. I want to add one more point to this, that even though while coal might be happening as a pushback for environmental considerations and policy around the world, and therefore that industry is on a decline because of that reason, very justifiably, I think the other one that's heading straight for us is AI. And with AI, it's just a massive reduction in the workforce that is required for many different jobs, whether that's in manufacturing or whether it's information and so on. Now, whenever automation gets mentioned, the response is often one of retraining. So the workforce's response to automation is we should retrain that workforce. Bringing this back to super funds, clearly we want technology, companies to embrace technology. We want them to do automation. We want them to make profitable decisions, but we want them to preserve or consider the impact on the workforce. So it's natural for companies to fire people. It's natural people to automate tasks that they should do. But in doing so, they should be really mindful of the fact that if they displace a critical number of people into a local town, community, or indeed the wider economy, then that has consequences on the local economy, on society, and back to Mary's point about universal ownership and this sense of being having many stakeholders in this. So I think super funds absolutely have a role to play in understanding how the workforce is shaped by changes like climate change, but also by automation and other factors as well, and having some role in understanding what is the corporate, especially effect on that. Unfortunately, they can't run training sessions, all right? So they can't actually proactively change the training level or the industries, but they can funnel money into promoting new industries, young industries, advanced manufacturing, space tech, cyber technology, etc., that provides new industries and eventually grows into bigger industries that hire those people that we are talking about, being displaced from technological disruption and so on. So there is custodianship there, but I think it's a custodianship that is shared with some element of the government, and that certainly creates complexity, I'm sure, for both sides.
Great, thank you. I'm now going to move to some of the questions that have come up on Slido. I'll just remind people that you are certainly more than welcome. In fact, you are encouraged to put your questions up on Slido. And you'll note that if you, if you look at the right-hand side of the screen, as you can see it now, you'll see that there are numbers next to the hands. That shows that people have voted up certain questions. And so what I am going to do is work from the top with those ones who've been voted up. So greetings, Shan. Long time since I've seen your name. Question from Shan Turnbull. What are the panel members, I'm actually going to probably direct this more to Mark, because he did touch on this actually, I think, in his presentation. What are the panel members' views about the concentration of power in the trustees of super, and if this should be countered by beneficiaries obtaining votes to protect and further their own direct interests and in their investee companies? To Mark.
So there's sort of a few points here. I disagree with the first premise that there's a concentration of power in super. Australian Super is the biggest superannuation fund, and we've got about an 8% market share. Of all the industries in Australia, the superannuation industry is the least concentrated, I suspect, of any industry. And so I wouldn't start with saying it's concentrated at all. The second point then is, I think the question is, should members be able to directly elect? The system's been set up the way it is, whereby it was a partnership between the employers and the employees in all funds, because the employers were the ones who paid the money, and the employees and by the unions were the ones who acted representatives of the employees' interests. and has performed outstandingly. So I can't see why I would change that for a direct election. And in my experience, I've been in the system a long time, those people have always acted in the members' best interests and not in the organisation's best interests.
Mark, I think knowing where Shan's interest often is, I think he's actually talking about voting on individual underlying companies rather than voting for the representatives on the boards of the super funds themselves. So it's way down into the company portfolios. I think that would be what Shan is referring to.
So is Shan after the point, should we ask the members what they think we should vote on particular corporate governance issues?
Sorry, go on.
Is that what we're heading?
No, I think what Shan would be saying is it's a bit like if someone had a self-managed super fund. They have the direct ownership of a share. They are the party who actually votes on any resolutions at that company. I think that's probably where Shan's coming from. I hope that's correct.
Yeah,
what I'm saying.
I think in that case, for the self-managed super fund, the person is their own trustee of their investments. For a super fund, you give those trustee rights to the fund you join. That's part and parcel of the system. So I don't think that's going to change. And the innuendo, second then becomes, how would you actually put that into practice? I think it'll be very, very difficult. Mary does this day to day. What does she think?
Nice handball. I think operationally it would be difficult, but not insoluble. I do wonder though what the problem is that would be solved by that. So for people who want more control over that sort of over those kind of decisions, self-managed super fund is the vehicle for that. For those that don't, for whatever reason, but one of them could be expertise, then it is right and proper that the expertise vests and the decisions therefore vest in the people who have that knowledge. So we're going to vote on a number of things in this upcoming mini AGM season. For example, we're voting on director re-elections and voting on shareholder propositions. You're voting on reappointment of auditors, voting on the acceptance of remuneration reports. If people believe they have the skills to make those decisions on their own portfolio, then self-managed super fund is a good vehicle. If people believe that there are experts in the field that can make those decisions and indeed make more of an impact by the collective action that can be behind the votes, then a collective vehicle is the right place for that. But I don't think operationally it's insoluble. I don't know how we would do it. That's why Mike's here. But I don't think it's necessarily the problem that needs to be solved.
I also want to add just a very quick point to this, which is outside of super, this is actually a much bigger question globally around passive investing and passive funds. So that's all.
Yep. The next question up there, we will go to Anonymous. From October 2020 till now, that's probably to Mark again. To what extent have investors changed their super fund asset allocations, i.e. from cash to the share market? Will such extreme investment sentiment create an unexpected shock to the stock market via the super fund channel? So I guess that might be two parts, Mark, actually. It might be partly about perhaps you can talk about the asset allocation changes that Australian Super made at the top level, which would be perhaps, let's call it in your default fund. And then perhaps you might be able to provide some comment on whether members themselves did much switching.
Yeah, good, thanks, Rob. We increased our exposure to shares in the September quarter last year, and by and large have held that allocation since then. When I talk to our two consultants, Frontier and Jana, who are the two biggest consultants in the pension market in Australia. Anyway, both of them implicitly allowed their clients to increase their weighting in shares as the share market ran up, but didn't really, I think, move to a substantially overweight position in equities because of their concerns about valuations. Because the market recovered very quickly, as I talked about in my presentation. So I think that those who increased their allocations have held it. Most funds have allowed their allocations to rise up with the market. And most are reasonably invested, but you wouldn't say fully invested in equities at the current time. As for members, members tend to react like momentum investors to what happens in the market. So when the market was falling, members were moving out of growth assets into defensive assets. And as the market turned, the members were trying to move back quickly back into growth assets. That's pretty much settled down. There's been a bit of money moving from defensive assets back into growth, but nowhere near as much. I think most members who are invested in growth assets understand the importance of growth assets for building long-term retirement savings, and then try and market time around corrections to avoid losing money. Unfortunately, that's an extremely difficult exercise for an individual member. So, Rob, you might be on silent.
Thanks, Mark. Sorry. Unless anyone else wants to add a comment to that, I'll take that one as answered. Moving to the next question, which is from Mamun. And I think this is a really interesting one for those who are at the earlier stage. You know, this is La Trobe Uni, so this is a good one from hopefully a student, or maybe it's from one of the lecturers asking a question, which hopefully will build on the argument they're putting to the Dean. How the finance education degree at university should change to stay relevant to the job market requirement of finance graduates. Do you think we need a cocktail graduate? Finance, economics, data science, computer science? Who would like to put up their hand to answer that question?
I'm happy to jump in for a second. So the way I think about this is that in some sense, a university degree is about learning how to think, and it's much more about general education and awareness and so forth. In another sense, a university degree is about enabling you to get your first job, to get a start in a career. And in that context, you have to be very aware of what is that industry looking for today. What do they want? And what are you going to bring to that industry that is unique? So unless you're entering an industry which is growing gangbusters, you're essentially going to be entering a job that requires you to bring something that they don't already have. So typically, I used to teach at a London university, so don't worry, not a direct competitor, and for a number of years. And during my courses there, I'd often make this point that really, you have to be very aware of what other skill sets being demanded in the workforce. And if the answer to that question is Python programming or data infrastructure or whatever else, then essentially those are the things that you need to bring to that job interview, essentially to be competitive and to bring something that's different. Now, I want to re-stress that this is about thinking about a university degree as a first job preparation or entry point or vehicle for that. It's not thinking about a university degree in terms of having a holistic understanding of how to reason, how to communicate, how to present, and all these wonderful attributes that many other kinds of degrees with many other kinds of focuses, from psychology to philosophy and all these soft sciences, will give you in spades and you can use for the rest of your career. This is just really about if that job requires you to be able to work with data and analytics and understand probability and be able to produce those dashboards that we just went through as an example case, then really you should be taught how to work with that and how to use that. I would add maybe one more point is that what I do see a little bit of lack of in that bridge between the educators and certainly the people we hire, and I've seen hired into financial institutions, is that probably a typical university will actually, especially if you do over science, you overtrain you for the amount of cool models and things that you can do. And most graduates I've seen get quite disappointed when they join a company. And the answer is no, just gather some data and create some pretty graphs for us for the next few years until you get a hold of what's actually happening. So I honestly think that in this case, all courses really in financial analysis and modeling have to keep up with technology. So they have to move from, I don't know, Excel to MATLAB to Python, whatever is the current thing that the industry is looking at and using, has to be aware of how to do things in the cloud and how to use these things, but then also probably just enough to be dangerous, probably just enough to be useful for a company as you come in there, but then being prepared that a company will then take your education further and will train you and invest in you and develop you. So I wouldn't go as far as to say you need computer science as a discipline, but I would say that you need these so-called digital tools or skill sets, and you need to be prepared that you'll be doing that for the rest of your life, once every 5 or 10 years.
Thanks, Mike. Mary or Mark, do you wish to add a comment?
Oh, yes, please, to the cocktail graduates, and not just in the way that you think, but I would endorse Mike's comments, because I don't know, I did a Masters of Finance. It's going back, 100 years now, but I reckon I vividly remember an assessment piece on the LIBOR rates and how to use, this is a London interbank, rate sort of thing. I'm sitting in Australia, in Melbourne, and did not learn how institutional investors design a portfolio. And I think there is a great opportunity for Australian educational institutions and students to take a hold of this yourself, to say, what is it? How would I participate, for example, in the pension superannuation space in such a way that combines a whole range of skills? In the responsible investment area, when we hire, I see 2 people, and Rob, you would have seen this for years and years and years. Because it's a youngish area, one set of skills will come to us with sustainability knowledge, deep sustainability knowledge, and very little investment knowledge. And the other will have deep investment knowledge and no sustainability knowledge. And so, just as a very live example of what super funds will look for in the future, and in impact and in stewardship and in purposeful capital, will be the combination of how you have deep technical investment knowledge and an understanding of how to value and apply ESG risk factors. And that's not one discipline at the moment, that's 3 or 4.
Thanks, Mary. Mark, I might just move on to another question, unless you really want to jump in. Oh, thank you. Mary, I'm going to go to the next question for you. Oh, hang on, I may well have just deleted it.
Was that the women one? Did you
yes,
delete the one about the women? Well, that's...
Yeah, I did. I should go into federal
there
politics.
There it is. Yeah, exactly.
So, Mary, at the risk of it being advice in answering this question, perhaps you can just make a short comment about the problems in respect to the current system and where it leaves women in their retirement.
You know how this won't be advice is because it's actually got nothing to do with, and I just want every person to write this down. Retirement balances being 47% less for women have nothing to do with the choices that women have made, and everything to do with the system that they are compulsorily required to participate in. So how this doesn't become advice is that I'm never going to say to someone with a lower superannuation balance who's, working in the aged care sector, for example, can you find an extra $20 a week to put into your superannuation account? Because that is a tinny off the charts, isn't it? When we know what they're being paid and we know the struggles of their life outside of work. Women on average currently retire with a lot less superannuation than men because the superannuation system doesn't reflect their working life. The system is predicated on time spent in the workforce and the amount of money that you earn while you're in there. So it's naturally going to have worse outcomes for those people who start off, for a start, on average in healthcare, $6,000 less than their male counterparts in their starting salary with exactly the same skills, doing exactly the same job. And then the superannuation says to women, when you take time out to raise another taxpayer, some people call them babies, it's I think helpful in this conversation to call them taxpayers. When you take time out of the workforce to raise another taxpayer, we're not going to pay you superannuation on your parental leave. What does that say to us? That is just discrimination, nothing else. And then the system doesn't actually ever allow you to catch up, because by the time you've taken time out of the workforce to raise another taxpayer, your male counterparts have been on that exponential growth curve. They're on a different part of the J. And you will never really catch up, not only because you'll never catch up in pay, which is a system issue, that you may not actually ever return to the workforce in a full capacity. So that's nothing about women. That's everything about the system. So yeah, many things that need to be done. Don't get me started.
Thank you, Mary. I'm going to actually jump down to one of the lower questions now, purely because I think it is a really important one from the point of view, I think, of the future of investing in Australia. And in fact, another one has disappeared out of my screen. Where's it gone? Oh, there it is. The question from Brett Elvish. So the second one down, please. Highlight. Yep. So I guess Australian Super's, one of the biggest investors in Australia. So I think what his question asking here is, how much is Australian Super moving away from investing in Australia, and how much of that's diversifying away from the Australian economy? I'm throwing that one to Mark, seeing it says Australian Super.
Yeah. Hi, Brett, and thanks, Rob. Super funds have been moving away from owning assets in Australia over the 20 years I've been involved in. It's progressively been becoming smaller. Part of it is because Australia is a small capital market. Part of it is because there's great opportunities in technology companies and others overseas. And part of it was the end of the resources boom, which made Australia less attractive than what it was previously. The key thing for us really is what's the opportunity set in Australia, and that comes down to valuations where Australia's are actually relatively cheap compared to global markets, particularly the US, and then the opportunity set to add value within the portfolio. So it's on the one hand, on the other answer here, it is that Australia looks relatively attractive at the current time, but the opportunity set is always smaller in Australia than what it is globally. For example, we've been looking at direct investments so far this year. I think if there was 10 we looked at, 8 of them were overseas rather than Australia. And that's pretty much, I think, that way the trend's going to continue going forward. The world's a really big place. Like the Australian equity market might make up 1 or 2% of global capitalisation. So even though we look from the lens of Australia out, there's 98% of the investment opportunity set lying outside of Australia.
I'm going to cut you off there, Mark, because I'm conscious of time and I don't want to be the one that runs over time, unlike the three of you who are so disciplined. So it's 3:15. This is the end of this plenary session. Thank you so much to our three speakers, Mary Delahunty, Dr. Michael Colo and Mark Delaney. Thank you to La Trobe for giving us all the opportunity to speak to you today. And to those who provided questions, thank you so much for enabling our speakers to either expand on previous comments or to touch on new ones. Thank you.
Thank you.
So thank you, panelists, for giving you a very valuable time for us. It's a very interesting and thought-provoking talk and discussions. So we will actually, we are recording this event. We will edit this one and made it available in La Trobe web page. So I just wanted to make sure that I give a bit of time to Phil to provide some concluding remarks. So then when he complete his concluding remarks, the session ends, because those who are participating in this event, they need to go to the different Zoom session, because we are going to have another 18 concurrent sessions of 18 times 4 papers. We have 72 papers will be presented from 3:30 to 5:30. So we need to make sure that everyone goes through those 18 concurrent sessions hosted by 9 universities. They host 2 sessions each. So over to you, Phil. Thank you.
No, thank you, Bella. Yeah, I found the discussion very informative across a range of dimensions. I thought Mark's comments about the future of investing pre and now post-COVID, I thought was quite interesting. We're clearly in a different environment. I think he's right. There's been a regime change. It's still not clear how that's going to play out, but I found his remarks pretty insightful. what Michael had to say about the role of AI in investing, I thought was also very interesting. I think AI is going to impact across pretty much every sector of the economy to some extent. The only question is going to be how much. And I think the investment and management industry broadly defined, and not just the actual investment of assets, but things like client membership handling, retention, marketing, and so on, are also going to be impacted by that as well. And then Mary's comments about cocktail graduates, I really resonated with me as well. Perhaps to put in a plug, La Trobe now offer a new degree, a Bachelor of Humanities, Innovation and Technology, which has been designed to produce graduates with exactly that mix of skills. So that they have a range of skills across humanities, but with practical applications into areas like innovation and technology and so on, that ought to make them ideal graduates for working anywhere in the industry. So on behalf of my employer, thank you very much, Mary, as well, and thank you to all the panelists. It was terrific.
Great. Thanks for having us. Okay. Bye.
Thank you.
Bye-bye.
Bye, everybody.
Bye-bye.
Thanks, guys.